The Australian Financial Review.
Hello, I'm James Thompson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is my Chanticleer colleague. He's worth more than all the shares in Australia's second biggest hospital company put together. It's Anthony McDonald. How are you, Anthony?
Yeah, fortunately, no $1.5 billion loans here, James.
Absolutely. Well, this week we reveal what the new strategy of one of Australia's biggest companies tells us about the coming AI boom. We take you inside the biggest corporate collapse since the pandemic, and we explain the new theory moving the market, the taco theory. But Anthony, let's start with a government decision that's going to shape the country for, 40 years. Mm-hmm. The approval to extend the North West Shelf liquefied natural gas project, which is operated by Woodside up there in Western Australia. Now, Anthony, the Environment Minister, Murray Watt, he was pretty open that this was going to make people unhappy, whatever his decision was. Did he get it right, though?
Well, it was definitely a spicy meatball of a decision. And yeah, I think it's right. But it's so controversial because it's gas, fossil fuels, climate change, it's big business. I mean, you're never going to make everyone happy. I mean, in a perfect world, the whole world would have already transitioned from gas and off all fossil fuels. We wouldn't even be having this conversation and we'd be on the renewable energy. The extension at the Northwest Shelf would be a no-brainer. It wouldn't even be needed.
Yeah.
But James, we're just not there. So we've come around to all realise we're not in this perfect world and the energy transition's not going to be a perfect thing and the world needs gas. And Australia has gas. Australia needs gas and we need it so badly that we're building an import terminal just south of Sydney here, James, which is quite unbelievable, really. And there's another one in planning for down at Geelong, but I think this decision, James, was a pragmatic one. You know, the Labor government, they really changed their message on gas in the past year or so. It is the transition fuel for the next few decades. And if you're okay using it here in Australia, James, you got to be okay extracting it, don't you?
Yeah.
I think that's what this comes down to. And it's something we do well. At Northwest Shelf, it's been operating for decades. This is an extension of it. It's a very, very big extension. It's our third biggest export. It's good for the country in terms of the country's balance sheet. So, yes, right decision. What do you think?
Yeah, look, I think we've been talking for a while on the podcast about how inflation changes everything. Yeah, it's changed the outcome of all these elections. Most of the incumbents got kicked out because of high inflation, Anthony Albanese being the notable exception. But the inflation story's changed the government's view on gas. In the last couple of years, it's become clear that because of inflation in the general populace, the cost of living going up, and because of particularly inflation in construction costs, the energy transition's not going in the way we want it to or ultimately need it to. It's just going to be slower and tougher and more expensive than we thought. And when you've got an affordability problem, you know, you need a transition fuel, as you say, to try and get us from one point to the other. Gas is something we've got lots of, and you can see in the last 12 months the government's really changed their tune on gas. And Meg O'Neill, the CEO of Woodside, she said exactly that the conversation's changed in the last couple of years as people are looking at their power bills and going, hang on, why is this going up so far? Don't we have lots of energy here in Australia? So I think you're right. Pragmatic decision. Does the Northwest Shelf go for another 40 years out to 2070? Well, hopefully not, I guess. But, you know, this gives Woodside the certainty it needs to invest certainly over the next couple of decades. So it's the one thing, Anthony, this has taken 6.5 years to get this approval in place.
Yeah.
That can't be right. That can't be good for any business in Australia. That is something that we need to learn out of this episode. We've got to move faster on this stuff.
Yeah, just quickly, James, for the chook hardcores out there, can you think of a busier company in Australia in the past 5 years than Woodside? You know, it bought BHP's petroleum business in a really rare scrip deal that was worth tens of billions of dollars, tried to buy Santos, sold a half share in its Pluto up there in the Northwest as well, went global in LNG last year when it bought into a US project called Driftwood. It now wants to develop that. That's going to cost tens of billions of dollars.
Yeah.
It bought a clean ammonia project in the US. That's another $2.5 billion US last year. And now it has this Northwest Shelf extension. And James, I saw Citi's analysts saying that could be a $25 billion development. It's huge maneuvering.
Yeah.
From a company that's supposed to be in a sunset industry, whose shareholders voted against this climate plan last year, some of whose shareholders tried to kick the chairman, Richard Goyder, out last year. There's so much going on there.
Yeah, that's true. But I think that's the nature of the beast, you know.
Yeah.
This energy transition is happening. It needs to happen. It's all over the shop. And so Woodside's going to be here, there, and everywhere. I think that's what we'll continue to see. They're going to need to be very nimble as this plays out.
Okay, James, it's been killing me since the start of this episode. What the hell is the taco theory?
The taco theory, Anthony, was introduced to me by Anthony Scaramucci,
the Mooch,
who was famously Donald Trump's press secretary for, I think, 9 days in the first Trump administration. I spoke to him a couple of weeks ago, and he said, everyone over here is talking about the taco theory. Trump, always chickens out. And since the Mooch told me about this a couple of weeks ago, and I put it in there, he's right. It's everywhere because Trump suddenly backed out of these tariff threats against China and against the EU, and investors just expect that he's going to back out on all these tariff and trade policies. Now, interestingly enough, Anthony, on Wednesday night, a very brave reporter in the Oval Office said to Trump, "Excuse me, Mr. President, have you heard of the taco theory?"
Oh, really?
And he said, "That's a nasty question." He said, "It might look like chickening out to you, but it's just good negotiating." Well, I'm sorry, Donald, but the market doesn't believe you, mate. They have just decided that you are going to keep backing out of these big threats that you've made. Doge is dead. The restrictions on government spending, they're gone. The tariffs, they look like they're gone. And so here we are. The market's surging. We're back above the levels we were at Liberation Day. The Wall Street's only off 3% from its all-time highs. You know, it's party time out there, Anthony. Does it feel quite right to you that it's party time?
Oh, not really, but I do like your taco theory. Trump always chickens out. Tariffs are coming off. We could probably keep the tacos going.
Nice.
It's highly entertaining, isn't it?
Yeah, it's like a Guzmani Gomez restaurant in here at the moment, isn't it?
Yeah.
All right, Anthony, let's get to our first big topic. And on Tuesday, we got a glimpse into the future when the telecommunications giant Telstra took the wraps off its new 5-year strategy. Now, Telstra, as we all know, it's a true giant of Australian business. There really wouldn't be too many of us who don't use its network or its digital infrastructure in one way, shape or another. And as we all become more connected, demand for that network and that infrastructure is only going in one direction. The amount of data going across the network in the past 5 years has tripled. And if you think of all the stuff you do on your phone, you can understand that.
Mm-hmm.
But Anthony, Telstra's got a problem, doesn't it? Demand's through the roof, investments through the roof, but Telstra is barely getting a return above its cost of capital. Anthony, tell us a little bit about what the cost of capital means and why have Telstra's returns been so poor?
Well, James, it's been like this for years. Like Telstra started out with a rolled gold network, owned by the government, subsidised by the government, regulated, lots of political pressure to keep it rolled gold, service all parts of Australia, the remote and rural stuff. It's a cost centre, not a profit centre for Telstra, and still is. I mean, Telstra's problem is that it's had to keep investing in its network, 3G, 4G, 5G, all that CapEx, James. It means it's got a premium network, the biggest and best in Australia.
Yep.
And if all was fair in love and war, it should be able to charge premium prices and, really, really premium prices. But, the two big competitors, Optus and Vodafone, while they're small compared to Telstra, they do keep it honest.
Totally.
And they keep things pretty competitive in the sector. I mean, their network works fine for most Australians, for most jobs. They do their best to keep the prices low, keep the pressure on Telstra. So Telstra's this big gorilla, but the other two have got networks that are competitive at least, and that sort of keeps a bit of a cap on Telstra's prices. So this constant reinvestment from Telstra, combined with the pricing pressure, combined with the regulatory and political pressure, which is still there, a couple of decades on from the privatisation, means that Telstra hasn't been able to really get the returns it should have on these really valuable assets. Now, the cost of capital is how much it costs Telstra to borrow, how much it should cost capital to spend shareholders' money, like what the return is that shareholders expect.
Yep.
And the returns that shareholders make, the profit, it just isn't enough to cover those numbers. Now, in the past, if you bought Telstra shares, you weren't really buying it for its profits, right? You were buying it for its dividend, right? And you expected it to make normally 28 cents a year in dividends it would pay out. You didn't worry so much about the capital growth, which would come from the earnings growth and everything, and you just milked the dividends for what they were worth, owned it for that. Now, if you've owned Telstra shares, and lots of Australians did, and I think more than 1 million still do, it's been a pretty sluggish ride. Which is ironic, James, isn't it? Because the company at its heart, it's about technology.
Yeah.
It's technology infrastructure. And what's been a better place to invest in the past decade than technology and tech infrastructure? So yeah, it's been a big problem for Telstra. James, that leads to the obvious question. What's the CEO, Vicky Brady, what's she going to do about it?
Well, look, the first thing she's going to try and do is over the next 5 years get Telstra's return on invested capital up from about 8% at the moment, which is barely washing its face, up to about 10%. And that would be absolutely industry leading in the telco sector around the world.
Yep.
How's she going to do it? Well, Anthony, I'm sorry to say she's going to make you pay. You're going to make us all pay. Look, I mean, at the heart of this is exactly what you said. Telstra's got a premium network. All Telstra's customers tell it all day and all night that it's got a premium network.
Yeah.
It dominates the mobile business particularly. What Brady needs to do is extract the right amount of return for that. So what we'll start to see over the next 5 years is Telstra sort of offering attributes of that network that people can buy if they need an extra premium service. I'll give you a couple of examples. Let's say you love streaming movies on the go. So you need a really good, really high quality, reliable service for that. Well, Telstra will make you pay a little bit extra for that extra reliability. You're a food vendor, right, at a big music festival. The one thing that can't go down is your payment system. So you might pay a little bit extra for a guaranteed spot on the network to make that work. You're a business that does artificial intelligence stuff. You need really low latency. You want the bits and the bytes going down the pipes really quickly. So, you'll pay a bit of extra for that. The idea, Brady says, is to sort of have a good, better, best service and charge people appropriately. Now, that is done, Anthony, in every sector you can think of. There's a tiered pricing model. It hasn't been done in telcos. They haven't been good at it. Basically, they've built the network and said, look how good this thing is. We might change your data inclusions or your data speeds a little bit, but that's all. So this is a bit of a step change for Telstra. And as more and more data goes down these pipes, as more and more of us become reliant on the network, it wants to get a return for that. And its shareholders do too.
You know what Telstra could do, James?
What's that?
For the ones that are into streaming and for the movies, they could make the first movie free. And it could be Jerry Maguire. And you can sit there and listen to someone saying, show me the money, show me the money. And then everyone can understand what Telstra's on about.
I think they'll have a much more subtle slogan than that, Anthony. Yes.
But James, you promised us AI. Where does this new revolution come into for Telstra?
Well, look, I mean, obviously it comes in through the demand they expect to see across its network. That's going to be AI driven. But the message I got was that what Brady's saying is that AI is not some sort of experimental thing now. It is here.
Yeah.
It's using AI to do all sorts of things on its network. So make sure that, recognize patterns such that if its network goes down, it can quickly do maintenance. It can do preventative maintenance. I mean, one of the interesting things, one of the big costs for Telstra is power and petrol. So yes, you need a lot of energy to keep the network going. But every time there's an outage somewhere on its infrastructure, someone gets in a truck and rolls out there and goes and fixes it. So if you can have AI, monitoring and self-healing, they called it, the network, then you can save a lot of money doing that. The other place you can save money is if you can deploy AI into your workforce. Now, we're already seeing a little bit of that. When you ring up Telstra and you get on ring up the call center and you've got an issue, it's a pain in the bum. No one likes that. Back in the day, they used to have to manually enter the notes from that conversation. Now AI does that for them automatically. Only saves the call center person 30 or 60 seconds per episode, but when you're doing millions of these a year, that starts to add up. Brady was actually quite honest. She said, look, in 5 years, the Telstra workforce will be smaller than it is now. Now, we don't know how much smaller. Is it 10%? Is it 5%? Is it 45%? I don't know, and Vicky Brady doesn't know, which is fair enough because the tech is developing very quickly here. But we've got a big AI summit coming up next week, Anthony. And to me, this is more proof that this stuff's becoming very real very quickly, isn't it? I mean, you talked to one of our big data center leaders, Greg Goodman, this week. Where does he think we are in this sort of whole AI revolution?
Yeah, one of our data center leaders, Greg Goodman. Now, James, that's a sentence you wouldn't have said like a year ago, let alone 2 years ago. It's amazing how much this space, to use Goodman Group's word, is changing. You know, like this is a logistics company that develops warehouses, logistics parks, that sort of stuff. Now it's really leapt into data centers. And he says it's hot, 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 you know, red hot. You know,
Yeah.
while we might think that the data center stories come off the boil a bit, he says like on the ground it's still red hot. It's as hot as ever. And why? It's just the simple message we've been hearing for a while now, James. It's that generative AI, which is the AI that can create new content like text, images, music, and video. And the data demand is going through the roof. The big software companies, Amazon, Microsoft, Google, Meta, etc., they're investing huge sums into AI, tens of billions of dollars a quarter, some of them, and they need data centers to make that growth come true.
Yeah.
So like I said, he's gone from logistics parks to jump over into data centers, and he reckons he's going to have 500 megawatts worth of data centers started by June next year. 500 megawatts is a lot. He's got one in Sydney at Artarmon, just up the road from North Sydney here. James got one down there for you in Melbourne, Tokyo,
Right.
Paris. Back of the envelope, 500 megawatts is about $5 billion worth of development.
Yeah.
Right? So Goodman Group will fund some of that itself. It'll also bring in some capital partners. The names that it brings in, James, as capital partners and the price at which they come in, or the return expectations at which they come in at, I mean, that's the bit that really shows you how hot this sector is. We don't really have that data yet, but
Yeah.
if Greg Goodman's to be believed, there's plenty of capital there. It's just a matter of getting the timing right. But for him, he says, for Goodman Group, they've got all these developments. They've been working away at them in the background for a bit. He said, but they're trying to do that prep work as fast as they can, you know, securing the power, securing the approvals, getting all the equipment. He said there's not many holidays at Goodman Group at the moment because there's this big opportunity there and they're all rushing to get it out. Basically he's saying, look, don't forget about the data centers theme. It is definitely not dead.
Yeah, fair enough.
Now, James, speaking of AI, we had NVIDIA's result this week. Can you tell us about it quickly?
Oh, well, you and your generative AI, Anthony, that's so old hat. That's
Is it?
That's last week, mate.
Oh,
I'm
mate.
onto agentic AI now, which sounds even cooler, doesn't it? This is all about AI agents. Now, AI agents, they're the ones that they can basically think for themselves.
Mm-hmm.
This is where you get an AI agent that can reason, work through a problem, and then take action. So, you know, you might have an AI agent that does, I don't know, summarizes the call center transcripts or does some other role. NVIDIA's idea is that we're going to have a sort of virtual workforce of these that you can just sort of pull off the shelf and say, yep, take that one, take that one, take that one. And that's where we're moving. Now, to be fair, that's where AI needs to move because the money's not in mum and dad sitting at home doing chat GPT searches on their next holiday. There's no cash in that. The cash is going to come from businesses replacing human workers with virtual workers.
Yeah.
It's that simple. Well, it's that simple and it's that scary and it's that exciting. That's where NVIDIA says we are now, and that's the next part of this revolution. So watch out. I think we're going to have a lot of fun at the AI Summit next week, chewing through some of what that means for Australian society, because going to have some implications.
Oh, yeah, there's a lot going on. For our second topic, James, let's look at Australia's biggest corporate collapse since Virgin. This week, Hospitals Group Healthscope's lenders finally called in the receivers and want it sold as soon as possible to try and recoup as much of their loans as they can. James, this collapse has been a while in the making. Owner Brookfield, via one of its private equity funds, paid too much and lumped Healthscope with too much debt and rent costs to survive any longer. Brookfield invested in June 2019 and officially loses control this week. It will dust all of its investment, estimated to be about $2 billion, and likely cause Healthscope's banks and landlords to dust some cash as well. James, this is a sad corporate story. I mean, it's a very important company, second biggest private hospitals owner in Australia, a huge part of the elective surgery production line in particular.
Yeah.
It's gone under. Its future is now up in the air. Australia's probably a little bit poorer for it. Now, it's tempting to blame Healthscope's private equity owner Brookfield for pushing it too hard on this investment. Do you think this was Brookfield's fault?
Well, Anthony, you put him in the private equity hall of shame a few weeks ago, so I find that hard to argue with. I mean, I think you said it right. They paid too much. They loaded up with too much debt, and they changed the sort of nature of the cost base where they got stung by a big shift in structural costs around rent and also wages. Now, did Brookfield see the pandemic coming, which unleashed all this inflation? No, fair enough. But things happen in business. You need to have a business that can withstand a little bit of change, or a lot of change, actually. And this business just hasn't been able to cope with it. Other businesses have, but the debt and the rent agreements particularly have just hamstrung this business. So, look, I think Brookfield has to take the lion's share of the blame here. There are some big structural changes in healthcare. We don't like going to have overnight stays in hospital anymore. We like going for day stays, and they are 8 times cheaper than staying in overnight. And so Brookfield suffered a bit from that. There's a question about whether the private health insurers are sharing enough of their profits to support the sector. I think that's a legitimate question that we'll see debated. But look, I mean, the company that signs the check has to be the one that bears ultimate responsibility, I think, and Brookfield's in that position. It's not comfortable, but that's the way it goes. I guess we can keep doing the postmortem forever, but what matters now for the people who are booked in for surgery in the next few weeks? What matters now is what happens next. So, are there potential bidders ready to come forward? They've had months to get ready. Are they going to suddenly step forward and pay a price, make a half decent bid, and keep this thing going?
Receivership should help, James. Like it really does. I mean, it puts a time frame on it, puts certainty around the outcome. Receiver's there to sell it. This is for sale. This is not Brookfield flying kites, which we've seen in the past. This gets the lenders together, gets the landlords together, gets Brookfield out of the way, gets Healthscope out of the way, gets Healthscope's board out of the way, and says, we're doing something. Like deals like this really are like herding cats. You need to get everyone on the same page at the same time, and it's so hard to do. Sometimes it's just easiest when you've got an outsider with sort of legal responsibilities and someone that the court will back if they have to take a side here and get something done. And that's what's happened with the receiver. Yeah. James, Healthscope CEO this week, Tino Spina, he told both of us if Healthscope has 3 problems, receivership is the best way to fix 2 of them. Too much debt and too much rent. The third one, which you just said then, the structural issues in the healthcare system, basically we have more private hospital beds than we need, for now at least, which is quite amazing if you think about our aging population.
Totally.
And the demands, and you hear hospitals are overrun, all that sort of stuff. That can't be fixed by receivership. The fact that, like you said, the models of care, people not doing as many nights in hospital, that can't be fixed by receivership. The fact that private hospitals are getting less of the private money that goes into the private health sector than they used to, about $1 billion less, according to Ramsay Health Care, that can't be fixed by receivership either. So there's still some problems there that whoever it is that ends up owning these hospitals is going to have to deal with. Receivership won't change any of those, but it should act as a lightning rod, perhaps for the industry, but most importantly, it'll bring all the parties together in terms of this actual deal. Now, James, perhaps the surprising thing, given what we've seen in some other situations in the past year or two, is that the government has pretty much stayed out of this one. It has sat back and it's let a business fail here.
Yeah.
Do you think that's a good thing or not?
Well, look, I mean, we've been critical of the government stepping in to buy a crappy steel plant in Whyalla and a pretty crappy regional airline called Rex. So, we can't slam the government for staying out here. Look, it was very deliberate. The Health Minister, Mark Butler, he made it clear that there was no way he was going to step in and use taxpayer money to fund a private equity-backed business. Yeah. And he was very clear about that. I think he even said a foreign private equity-backed business. So the government wants Brookfield out of the way too. And so now they've cleared the decks. So the opportunity is there, at least, for the government to come in and start fixing some of these big problems. But they're going to need to. This isn't just going to heal itself. Butler called, I didn't get this, but Butler called Healthscope an outlier. It's not an outlier. Yeah. Private hospitals are struggling big time. Mm-hmm. And so unless there's a bit of industry reform, unless they sort of use this as the lightning rod, as you say, then we could have another hospital back in the sick bay in the not too distant future. So, which brings us, Anthony, to what are the lessons here? What are the lessons for the country, for investors, even for the health system?
Well, James, you know me, my mind goes straight to deals, the way deals are done, the way these private equity bids sort of work.
Yeah.
Australia has this thing for assets with infrastructure like properties.
Oh, yes.
All these businesses, they're operating businesses, but anything with a government contract, earnings that can be called defensive, the financial engineers can't help themselves but look at this and say it's infrastructure like. That means we can pay a lot for it, we can load it up with debt, we can run it on a shoestring budget, we can get earnings going up and then float it back on the ASX to suckers out the other side and make some easy money. James, this one makes you think twice.
Yeah.
You know, that such a defensive business could go bust is almost unimaginable if you're talking about an investment grade type structure, industry player coming in with industry player like debt to equity ratios. It just wouldn't go bust, right?
Yep.
But it's completely understandable when you get your head around the financial engineering that Brookfield had to do just to get this deal done in the first place, and then pile on what happened in the industry soon after. Like you said, COVID, the structural change, etc. So I think it should provide a bit of pause for thought, really. Like, what is infrastructure? What sort of businesses should you load up with fixed costs like rent and interest payments? How defensive are hospital earnings? You know, what comes with being a government-backed sector like private hospitals, which wouldn't exist at such scale if it were not for the government-mandated and funded private health insurance system and not Medicare. What responsibilities come with that in tough times? Like, can you just cut costs? Can you get your way through things like you might normally do for a less important business? For me, that's one of the lessons. I mean, the other thing we've heard a little bit this week, people saying about FIRB, the Foreign Investment Review Board, which looks at all foreign investment in Australia, or big ones in property at least. And perhaps they should have a good hard look at themselves. Like, why did they let such a big deal on a systemically important business like Healthscope happen in the first place in 2019? It's a good question, right? Because FIRB's job is to protect the national interest, but normally we see that along security lines.
Yeah.
You know, Chinese buyers have been ruled out of buying electricity networks, for example, or pockets of national interest. We normally think like the farmers. GrainCorp wasn't allowed to be bought by the Canadians because they were worried about the farmers and what it would do to grain supply and the way the grain was moved around in regional areas. But what about bidders blowing themselves up financially on important assets? Should that be a category?
I don't know. I mean, how does FIRB look into the future and say, what if there was a pandemic that sent inflation up to 9%? Like, is that realistic, Anthony?
I don't think it is. No, I don't think it's realistic at all. And if we're getting FIRB to be a ruler over financial structures like that, I think the country's lost the plot, personally.
Can I give you one lesson?
Yep.
So every year, the government, the health minister, comes out and tells us how much private health insurance premiums are going to rise by. Now, that health minister likes his job. He wants to be voted in back next time. He never puts through an increase that's probably what it should be. He always tries to get that increase as low as possible. But the problem is, as with lots of things in Australia, we sort of never want to pay for what something's actually worth or actually required.
Yeah.
And so we strangle the amount of funding at the sort of top of the funnel, and then we set the insurers and the private hospitals against each other to try and fight as hard as they can for that artificially constrained pool. I think we just got to figure out, we are getting older, we will get sicker, it is going to cost more. And we've sort of got to cop that. And at the moment, we've got this system where we don't let that price signal flow through to the market. We let a bloke who wants to get re-elected, or a person who wants to get re-elected, we let them control where the prices are set. So I think that's an issue too. Mark Fitzgibbon, who used to run the health insurer NIB, he says get an independent umpire to do that job. Take it out of the hands of the politicians. I reckon that's a good start too.
Yeah, well said.
All right, we'll be back after the break, Anthony. We're getting a very important health check for the Australian economy next week. Back in a sec. Well, welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. All right, Anthony, we mentioned on Tuesday we'll be up in Sydney for the AI Summit. I think it's sold out. It's going to be really good, isn't it? A really good sense check of where we're actually at.
Oh, totally. Such good timing for it, James. There's lots and lots happening, as we've spoken about earlier.
Absolutely. On Wednesday, we get GDP growth figures here in Australia now. We saw the inflation number, monthly inflation read during the week. It came in a little bit hotter than we expected. Does that mean a July rate cut is off the table, Anthony, do you think?
Potentially. I mean, as for this GDP number, I saw JP Morgan, we're expecting 0.3% quarter-on-quarter growth, which sounds all right, James, but remember the RBA is expecting 2.1% for this calendar year. So if we are going to hit 2.1% for 2025, it sounds like we're going to need it to pick up in the second half.
Yeah, well, I mean, Paul Bloxham, who's the former RBA economist, now at HSBC, he says the maximum the economy can grow is 2% now.
Oof.
And he reckons we've really got an issue. So this GDP number is going to be really interesting to see. All right, on Friday night, we're going to get US job numbers, which leads us into our question for the week. We love questions here at the podcast. Our question this week is from Inez Zeng from Wollongong. If you've got a question you want to send in, you can email us at chanticleer@afr.com. You can also send us a question in audio form by recording a voice memo on your phone. Just include your name and where you're from and email it to us. And of course, some of you will have noticed that there's now a widget that allows you to ask questions on every Chanticleer article on afr.com. We're getting great questions through there. Please keep them coming and we'll get to as many as we can. Let's hear from Inez.
Hi, Anthony and James. I was wondering, with the whole US debt situation, could you outline the best and worst case scenarios? What would happen if US became debt-free, and conversely, what would happen if the US government went bankrupt? How would this affect Australia? Thanks, Inez from Wollongong.
Inez, that's a great big picture question.
Oh, yeah.
Anthony, you want to start?
All right, well, let's think about the US being debt-free. The US's debt was worth 124% of its GDP last year, 1.24 times GDP. So they had US $36 trillion in debt, and the GDP, so the economic activity of the country, was worth US $29 trillion. That's a lot of debt, James. Now, that debt would take a lot of repaying. Just to pay the interest on that debt. Don't even worry about paying off the debt. Just to pay the interest on that debt, they're looking at close to $1 trillion a year. Now, James, remember the US budget deficit is running at close to US $2 trillion a year. So the debt's actually getting bigger. The interest costs are going up. So unfortunately, Inez, I find it really hard to see how that debt's going to be paid off in full. If it does happen, it's going to take... Yeah, it's hard to see it happening in our lifetime. It's going to take a while, unless they've got an inheritance from a rich aunt in Saudi Arabia or something. It's just so hard to see it paid down via repayments. I mean, the way it could get debt free then via some sort of restructure where the lenders get wiped out. Like, yucks, that is take your cash out and hide it under the mattress. Type bad. That is end of day stuff in terms of financial markets.
Yeah, I mean, I think the best scenario, Inez, is that the government doesn't have to pay down its debt immediately or even in a hurry or even entirely. Like a bit of debt for like any household or business, a bit of debt is actually a bit useful. Lets you do things. So the best scenario, I think, at the moment would be if the government recognised the problem and sort of committed to tackling it over the long term. If it does that, then the people, the bondholders, the people who lend the US government money every 10 minutes, they would say, look, okay, we get it. You know, the US is a responsible borrower. They're doing the right thing. They get the problem. They're going to attack it. That would be the best situation because the cost of money would fall. But at the moment, we've got the cost of money rising. It's quite high. And that's because the bondholders don't believe that the government wants to be responsible. They're just seeing them spend like a drunken sailor and cut taxes. So could the US government go bankrupt? It's possible. Again, extraordinarily unlikely. We have seen countries go bankrupt before where they can't meet their debt repayments. And as Anthony says, that is just crazy for the bondholders. They would push the price of money through the roof, and that would come back to bite Australia. Because all of our banks, for example, they have to go into international bond markets to raise money, and they would need to pay a higher prevailing price for that money. And guess what? The banks just wouldn't eat that cost. They would pass it through to borrowers down here. And so the cost of money would go up for the entire world. So, I mean, that's why the bond market matters, Anthony. That's why when we hear these stories about people becoming worried about the American debt situation, it actually does matter to Australia eventually. And so we want them to get it sorted out as well, right?
Absolutely. Mate, if the US goes broke, that's like Healthscope times a gazillion.
Yeah, well said, Anthony. Well, Anthony, before we go today, we wanted to take a moment to pay tribute to an integral member of the Chanticleer podcast team and indeed, Anthony, the leader of the AFR's podcast division. Lap Fan, who is our super producer and the head of podcast here at the Fin, is very sadly leaving us to start a new chapter with his beautiful family in Vietnam. Now, Lap's just a brilliant guy. He's calm, he's enthusiastic, he's energetic, and he's relentlessly positive. He's just a great guy to work with. But I think it's really important to recognise the role he's played in building up the Fin's podcasts. From the very first podcast we did, which was an award-winning series called The Sure Thing, go and check it out if you haven't listened, Lap's been the champion of the format inside the Fin. Now, he's held the hands of countless reporters like us trying to make the format work for the first time. He's worked tirelessly with advertising and marketing and editorial. He's experimented with different formats and ideas, and he's helped bring tens of thousands of new listeners and readers into the AFR fold. I think, Anthony, being first through the door, being a pioneer of something is often really hard work and it's sometimes thankless. But Lap, your contribution to the AFR is mighty. And the fact that you've done it with a big, passionate smile on your face is what we'll remember most.
Here, James. I mean, the Chanticleer pod wouldn't have done as well without Lap. Of all the things the Financial Review's tried in the past decade, I reckon podcast is right up there in terms of the success, and a lot of that credit has to go with Lap. His endless energy, enthusiasm, ideas, and pursuit of what is a really good form and something that our readers and our listeners have really responded to. So, yeah, on behalf of you, James, on behalf of our other super producer, Alex Gow, and myself, we'll really miss you, Lap, and we can't wait to come and record a live pod in Vietnam on our next world tour.
Well said, Anthony. We'll see you later, Lap, and we'll see you all next week. Thanks a lot for listening. If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thompson, and Anthony McDonald, and it was produced by Alex Gow and Lap Fan. Our theme is by Alex Gow, head of podcast is Lap Fan, and the head of premium content is Fiona Buffini.
The Australian Financial Review.